Hey everyone, it's Duane Buziak, your Mortgage Maestro, serving Virginia, Tennessee, Florida, and Georgia. Welcome back. Today, we're looking at how mortgage trends are shaping up as we close out 2025, and what that means for you, the homeowner. We'll cover rates, equity strategies, digital lending, and how to make the most of your financial position before 2026 arrives. Let's start with the latest market snapshot. After several quarters of uncertainty, mortgage rates have finally started to level off. The Fed has signaled patience, holding its benchmark rate steady while monitoring inflation's steady decline. For borrowers, that means fewer daily rate spikes and a bit more predictability. Current averages are hovering in the mid-6% range for conventional loans, with slightly better pricing for VA and FHA programs. It's not the record lows of 2021, but it's a healthier, more balanced environment. And that stability is key. When rates hold steady, confidence returns, buyers re-enter, refinances make sense again, and planning becomes possible. Now let's talk about home equity, one of the most powerful tools in your financial toolkit. Across the Southeast, property values remain resilient. Even with slower appreciation, most homeowners have built significant equity since 2020. That equity can be used to fund home upgrades, consolidate debt, or create financial flexibility through a home equity line of credit or home equity loan. At Coast to Coast Mortgage, we've seen record activity in both of these areas. Our digital HELOC platform has made it faster and simpler than ever to access funds, often with approvals in days, not weeks. That's part of the innovation that helped our company surpass $1 billion in loan volume in August 2025. And for that milestone, I want to say a heartfelt thank you to every client and partner who made it possible. So, how do you decide between a home equity line of credit and a home equity loan? It comes down to purpose and personality. If you need flexibility, funds you can draw as needed, a HELOC is the way to go. You pay interest only on what you use, and you can reborrow as you repay. It's ideal for phased projects or expenses that vary over time. If you prefer predictability, a fixed-rate home equity loan gives you one lump sum and stable monthly payments. That's perfect for defined goals like major renovations or debt payoff. Both tap into your home's value, but they fit different comfort levels. Now, let's touch on the bigger economic picture. Job growth remains steady, consumer sentiment has improved, and economists expect the Fed could consider its first rate cut by mid-2026 if trends continue. That means we may see a gradual easing of mortgage rates, not a dramatic drop, but enough to create fresh refinance opportunities. So what should you do in the meantime? Use this stability period to prepare. Review your credit, update your income documentation, and evaluate your current mortgage. The homeowners who prepare early are the ones who move fastest when opportunities appear.